All right, let's get right into it. The latest Q3 earnings from the US tech giants, they're telling a very clear story. We've hit a major turning point with AI. It's no longer just about exploring ideas. We are now in the middle of a full-blown infrastructure build-out. What we're going to do is break down exactly how this new reality is forcing a rethink of strategy and, maybe more importantly, where the money is going across the entire tech sector.
So, we've structured our entire analysis around three core findings. First, there's a huge paradigm shift happening in what kind of computing power is actually in demand. Second, this is kicking off a capital arms race that's putting some serious pressure on free cash flow. And finally, we're seeing this fascinating strategic divergence. You've got 7 giants, and they're all taking very different paths to try and dominate the AI space.
Okay, so let's start with that first big idea, the new paradigm and the arms race it's creating. You see, the massive investment cycle we're in right now isn't just about needing more compute power. It's really about a fundamental shift in the kind of compute power that's needed, and the fact that it's needed constantly, 24/7.
So what is this big shift? Well, it's all about moving from training to inference. For a long time, the game was all about training, these massive, intense, but periodic bursts of computation to build the big AI models. But now, with the rise of what we're calling agentic AI, AIs that can handle complex, multi-step tasks for you, the demand has completely changed. We've moved to a world of real-time inference. This means continuous, widespread computation is needed for every single interaction a user has.
And the result of this? It's pretty profound. It means there's an exponential jump in the compute demand for every single thing a user does. This is why the investment cycle in infrastructure isn't just a short-term bubble. It's a sustained, long-term trend. Think of it less like a sprint and more like a marathon of continuous investment. And that, right there, is the core justification for the massive capital spending we're seeing across the board.
All right, that brings us to the core of the battlefield, the tight integration of cloud and chips. Now we're going to look at the 4 key players in AI infrastructure. That's NVIDIA, Microsoft, Google, and Amazon, and really dig into their different strategies. This is where that capital arms race is at its most intense.
Let's start with NVIDIA. I mean, what a transformation. This company has completely repositioned itself. They're no longer just a chip supplier. You have to think of them now as the foundational utility for the entire AI economy. Their strategy isn't about selling individual chips anymore. It's about delivering entire integrated AI factories. It's a brilliant systems-level play that, of course, creates some very powerful customer lock-in.
And you can see the scale of this change right here in their revenue mix. The data center business, which is almost entirely driven by AI, now makes up nearly 90% of their total revenue. I mean, that is a complete reinvention of a business model, and it happened in an incredibly short amount of time.
But with this incredible expansion comes a pretty significant systemic risk. What we're seeing is that cloud providers are taking on long-term debt. We're talking 10, 20, even 30 years to pay for GPUs that really only have a useful life of maybe 3 or 4 years. That's a huge mismatch between the asset and the liability. We're calling it a GPU debt system, and it's a fragile financial structure that definitely needs to be watched very, very closely. Okay, now let's turn to Microsoft. Their strategy, in their own words, is to build a planetary-scale AI factory. And what this really means is they're weaving AI into every single layer of their tech stack, all the way from the Azure cloud infrastructure at the bottom to the apps we all use like M365 Copilot at the top.
And here's the proof that the strategy is working. Just look at Azure's growth this quarter. It grew by 33%, which is impressive on its own. But look closer. A full 12 percentage points of that growth came directly from AI services. This is a really clear signal that for the big cloud platforms, AI is moving from being just a huge cost center to a very real, very material driver of revenue. But it's crucial to understand that Microsoft isn't just betting everything on OpenAI. They're playing a very smart dual-track strategy. On one hand, yes, they're locking in that long-term partnership with OpenAI, but at the exact same time, they are pouring money into developing their own models, like May-I-1 and their own custom chips. Why? To make sure they're not too dependent on any single partner in the long run, and that includes both OpenAI and, of course, NVIDIA.
Google's approach is a little different. You can think of it as a barbell hardware strategy. At one end of the barbell, they're embracing NVIDIA's GPUs to make sure they're compatible with what the rest of the market is using. But at the other end, they are doubling down on their own proprietary chips, the Tensor Processing Units, or TPUs. These are custom-built to give them a major cost and performance edge for their own massive internal workloads, like training the Gemini models.
Now, if you want to see just how massive this capital spending cycle is, look no further than Amazon. Their free cash flow over the last 12 months dropped by a staggering 69%, and that drop is a direct result of pouring nearly $116 billion into AI-related capex. Now, what's fascinating is how the market is reacting. For the most part, investors aren't seeing this as a sign of weakness. They see it as a necessary strategic move to build a long-lasting competitive moat in AI.
Okay, so we've talked about the infrastructure layer. Let's move up the stack to the battle over applications and the ecosystem. And up here, you can see a really clear split emerging. Basically, two completely different philosophies on how this market should be built.
And here are those two competing visions side by side. On one side, you have Meta. They're making a huge open source play with their Llama models. The goal here is pretty clear. They want to create an open standard for AI, sort of like what Linux did for operating systems, and prevent any one rival from locking up the platform. And then on the other side, you have Apple, doing what Apple does best. They're doubling down on their classic walled garden approach. It's all about on-device processing, a new private cloud for security, and using AI to drive what really matters to them, hardware sales.
Now, what's interesting with Meta is that while their main strategy is all about open source software, they've actually scored a surprise win on the hardware front. Their Ray-Ban smart glasses have captured over 70% of the market, and this is a huge deal for them. It gives them a crucial entry point into physical AI and, maybe more importantly, a fire hose of real-world visual data to train their future models.
So whenever you see this much money being spent and so much of it fueled by debt, you have to ask the question, are we in a bubble? So for this next section, that's exactly what we're going to do. Assess the risks and try to put today's environment into some historical context.
And this really is the critical question for the entire market right now. Is this 2000 all over again? A speculative bubble that's about to pop? Or is it more like 1995, where we're just in the early days of a truly foundational technology shift, and all this infrastructure spending is completely justified?
You know, the arguments for a bubble are pretty strong. You've got that GPU debt system we talked about, which feels fragile. You had this real sense that the infrastructure build-out is way ahead of our ability to actually monetize killer apps. And then you have the leading AI model developers, like OpenAI, who are just burning through cash, with projected losses in the billions.
But then again, the counter-arguments are just as compelling. First, unlike the dot-com era when we had all that dark fiber sitting unused, today's GPUs are sold out and running at or near full capacity. Second, all this spending is being driven by real demand, these massive contracted backlogs from cloud customers. And third, AI is already having a real deflationary impact, driving actual productivity gains and cost savings. And that provides a very fundamental reason for all this investment.
So, where does that leave us? It brings us to the strategic endgame. Because at the end of the day, the real challenge here isn't just about who can build the biggest infrastructure. It's about who can convert that massive capital investment into real, sustainable value the fastest.
This table really brings it all together, giving you a snapshot of where each of these competitors stands, both financially and strategically. We're looking at everything from revenue growth to their key AI metrics and CapEx trends. You can see Amazon's massive $116 billion spend over the last year, right next to Meta's Advantage Plus platform hitting a $60 billion annual run rate. And the key takeaway here is pretty clear. Even though they're all fighting in the same arena, every single one of these companies is running a very different playbook.
And that brings us to the final and I think most important question that will define this next phase of the competition. Who is going to win? Well, it's not going to be decided by who has the biggest model or the fastest chip. The winner will be the company that first figures out how to translate all of this massive compute power into sustainable, growing, free cash flow. That is the fundamental challenge ahead.